The media is full of mixed messages at the moment about what's ahead for our economy, even though they seem to have clearly changed their views on what's ahead for the property markets with much more positive reporting. In today's Property Insider Chat, Dr. Andrew Wilson and I are going to unpack a lot of the latest economic and financial news, the macroeconomic factors that are going to give us a hint at what's ahead for our economy and our property markets. If you want to keep up to date with the latest property market research and insights, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. The media is full of mixed messages about what's ahead for our economy. However, there's been a clear shift in the media's reporting of our property markets now that prices have been rising in Australia for 8 months in a row, and there's been many positive messages in the media. Last week, it was quick to report forecast by one of the big four accounting firms, KPMG, that suggested that property prices could rise 15% in the next 2 years. They're suggesting limited supply and high demand will ultimately outweigh high interest rates. Now, we know how good forecasts are, especially from accounting firms, but anyway, when it comes to what's ahead for our economy and interest rates, the messages are mixed at the moment, as I said. I guess if we want interest rates to fall, we're going to need the bad news to get worse first. In other words, bad news might end up being good news for those with a mortgage. Now, at the end of last month, Dr. Andrew Wilson's My Housing Market reported national house prices continued to rise in September, marking the 8th consecutive monthly increase, although the rate of growth slowed down due to affordability constraints. With the price of houses growing more slowly, some are wondering what's ahead for our property markets. So today we're going to look for some clues in the news as Dr. Andrew Wilson and I discuss some of the latest economic statistics that came out over the last couple of weeks. Good morning, Andrew.
Yeah, good day, Michael. I was interested in your comment regarding those forecasts for what is quite heady prices growth over the next 2 years. I don't share those sentiments. It seems we're either getting the boom forecasts or the bust forecasts, and both of them are typically wrong, and I don't think it'd be too long before those forecasts are revisited. I still think we're going to have positive territory for house price growth, but we're already seeing signs that the very strong growth this year is predictably starting to ease. So I think we'll get growth, but it certainly won't be at those levels going forward. But I'm sure those forecasts have plenty of disclaimers to them, and they do achieve what they're designed to achieve, probably primarily, and is to get a few cheap headlines.
Well, with the media being more positive about property, that's going to increase buyer and seller sentiment. But let's have a look at some of the things that have been happening in the market over the last little while, the macroeconomic factors that are going to affect our economy. And the Reserve Bank keeps a track of retail sales. It's an idea of how consumers are feeling and what they're spending. And they were up again in August, Andrew.
Retail sales were higher. Yeah, that's correct, Michael. I think that the big picture really, in terms of all the recent data that we've had coming out, is that there's just no sign that higher interest rates, 12 interest rate increases, have had the effect the RBA was hoping. We still have a booming economy, and all the other measures in the real economy are positive for growth. I'm not sure where the Reserve Bank go here, given that, we're likely to get another pause in rates over October, and we're certainly in a pause, wait and see environment at the moment in terms of official rates, and yet we keep getting all these positive results from the economy. And as you mentioned, retail sales up by 0.2% over the month, which is up by 1.5% over the past year, lower than the 0.5% rise recorded over July. Now, the ABS, that's been sort of making a bit of a habit of putting some commentary into their results. Not sure their commentary's completely on the mark, but they're saying that even with that 0.2% rise, it does overstate the retail sales position because it's not accounting for high population growth. It was a surge in migration, of course, and high inflation, which of course is elevated prices. So that's the price effect, because retail sales are obviously measuring the value of sales. So that 0.2%, although positive, is, in the ABS's opinion, still overstating the retail sales position, which they've been quite keen to point out is not as good as it perhaps appears. Not sure they should be in that field of commentary, but nonetheless, I think the ABS is, and mentioning that the declining trend growth over the year was the lowest on record, Michael, according to the ABS. The annual trend growth was the lowest on record. But I mean, we've got to put this all in context. When we look at where we are now, we're still so far ahead of the pre-COVID position in terms of spending that, of course, we were going to run out of fuel to continue to spend, but we're still growing. And the point is that we're growing at a rate higher than a year ago, which was fueled by all those stimulus packages that consumers took advantage of. So I'm not sure how the ABS can continue to point that this is a sign that, consumerism is being affected by high interest rates. We're still spending like drunken sailors, but it's just our spending rates aren't increasing, Michael.
Now, at the same time, inflation figures came out, and in August, inflation rose a little bit, Andrew.
Bit of a surprise, Michael, perhaps, but we're going the other way now. All of a sudden, headline inflation up from 4.9% to 5.2%, and that followed the previous month's fall from 5.4 down to 4.9. Underlying inflation continuing its downward trek, down from 5.8 to 5.5%. But the contributors to inflation were again housing up by 6.6%, food up 4.4%. And we had a big reverse in transport costs, which means fuel, Michael, which increased by 7.4%. And this, of course, reflects what we're seeing, a surge in international oil prices. The US dollar per barrel price has increased now. It's over $90 US a barrel, which is well above its recent lows, which were down under 70, and we're really significantly higher than the sort of pre-COVID levels, which were about $30 or $40 a barrel. And this, of course, is causing a lot of concern for those that are trying to control inflation. Of course, there's more to come in terms of higher fuel costs, because if we continue at these levels, we'll obviously be higher when we get the annual data from our lower levels of earlier this year. So once again, we're not really seeing the victory over inflation that we would have expected following 12 rises in official rates. And it does bring into question the decision by the RBA to pause, without really the data to support the pause, over the past few months. The underlying inflation rate, which is the preferred measure of the Reserve Bank, is down to 5.5%. But we've got to remember that the target range is 2 to 3%, Michael. So we're still well ahead of that, or significantly higher than the target range, which the Reserve Bank has said it expects at this stage get to the target range in 2 years' time, which is quite a way off, and we can see things happening that maybe will stop that occurrence, that prediction, and we shouldn't be surprised given the recent record of the RBA in terms of its predictions. What we're seeing with fuel is just an example of that these things can come out of left field to upset the apple cart. But yes, inflation, bit of a shock rise, or a bit of a shock to see inflation rising again, Michael. And really, in my opinion, it shows clearly, both with retail sales and inflation, the work has lots more work to be done.
Well, the Reserve Bank's also been suggesting unemployment levels are going to have to lift a bit, again, to slow down inflation, to stop us spending. But the latest unemployment figures came in and there really wasn't a change.
It was even, more profound, the results, than we've seen recently. We've questioned some of these seasonal adjustment figures. There are issues with the ABS and their seasonal adjustment modelling. They've admitted this because of what happened through COVID. It's going to take some time for that to settle down. So we do get this volatility from month to month, but this time we didn't get volatility. We got a sort of similar low result. In fact, the unemployment rate was steady at 3.7%, which of course is off its recent lows of 3.5%. But we had a job surge over the month of August, up by 65,000 jobs created. The unemployment numbers also fell, down by 3,000. And the participation rate soared to another record, or to a record high 67%, Michael. The figures still reflect an easing in the labour market. I can't see it, because if we had a lower participation rate, Michael, we would have had a record low unemployment rate. So this is just amazing stuff, that we're still creating jobs, losing the number of unemployed, have a low unemployment rate, and yet we have more people in the workforce as a proportion of the potential workforce as we've ever had in our history. This doesn't show any sign of interest rates impacting the labour market, which, in my opinion, has to happen before we control inflation.
This is also the time when there's a lot more Australians here looking for jobs. Overseas migration has been pushing up our population growth strongly. Definitely been one of the things underpinning our strong housing markets. But despite more people available for work, unemployment hasn't gone down. Boy, there's been a strong rebound in immigration.
Well, predictably, Michael, of course, we're at the trough, the depths during COVID where we locked our borders. We've bounced back strongly now. Net migration is in Victoria back to its high levels we had over the March quarter, the annual results of the March quarter, and that's the latest data, 132,000 net migration into Victoria, with New South Wales just below at 123,000. Queensland's still very strong with 101,000 net migrants over the year to March. And of course, this is, as you suggested, a key driver of housing market activity, given we've gone from sort of nothing to this surge. And of course, they all need to find somewhere to live. When we look at the breakdown in the figures, it's interesting that net overseas migration, Michael, that New South Wales are leading in terms of net overseas migration, leading Victoria, which normally it's the other way around, and I'm sure that'll reverse sooner rather than later. But nonetheless, a very big number for New South Wales, again, reflecting perhaps that the drive into the Sydney housing market. When we look at over interstate migration, Queensland's still leading the charge there. We've still got a hangover from that exodus that happened out of those lockdown states of New South Wales and Victoria during COVID. But we're starting to see a rebalancing there, with the numbers out of Victoria now easing, likely back to a positive position for net interstate migration out of Victoria over the next few quarters. But as usual, New South Wales is the leading underperformer in terms of net migration, and that's why we've seen Victoria account for more total migration, and New South Wales net interstate migration, again, the underperformer. But that's why we see that Victoria has the highest net total migration, whereas New South Wales has the highest overseas migration, which is offset by that negative position for interstate migration. So look, nothing's changed there. This will continue, Michael. We'll continue to see a surge in migration. I think it's interesting, and we probably discussed this when we speak about our rent report, is that we're seeing with those high international migration numbers, obviously international students are making up a significant proportion of that. But the difference now in terms of the absolute results is that we're not seeing the outflow of students that we normally have as part of our net migration number, because we haven't had students here for a couple of years. So we're not losing students going back after they've completed their education in Australia. We're just getting a net positive without the counterbalance of the negatives of those that are leaving. So that means obviously even more pressure on our housing requirements.
One of the factors that we like looking at as a leading indicator of what's ahead for our property markets are loan approvals, and they're now falling, Andrew.
Yeah, look, again, volatile, the results with the home lending data. I don't want to sound like I'm sort of loading up on the ABS here, but again, even though the trend is higher, as we would expect with a rising housing market, it has been a little bit up and down. Once again, questioning that seasonal adjustment numbers. We know that there's plenty of buying activity happening this year, really across the board, but it's not being reflected at the same month-to-month level as we're seeing. It's not being reflected in the housing loan data. But nonetheless, as I said, the trend is positive, both for investor lending and also for owner-occupiers. And just sort of following on from the position regarding the measurement of home loans, the ABS is actually not recording first home buyer lending now. It has said that it's not going to be producing first home buyer data. They've got some question marks over the reliability of the first home buyer lending data. So APRA and the ABS are now working on fixing that, and they can't give us a position on when they feel that they'll have that data out. So we don't know what's happening with first home buyers in terms of that official result from the ABS that we've had for many years. So once again, this is a concern because those data points are very important, particularly in understanding what's happening with the first home buyer market, which is a key force, as you said, leading indicator of affordability. But nonetheless, we're still below where we were a year ago in terms of home lending, and certainly well below our previous peaks for both owner, occupier and investor lending. But certainly the trend has been higher this year. And perhaps we, as the ABS suggests, we need to look at the trend and understand that there are perhaps some issues with seasonal adjustment models. When we look at refinancing, which of course was a heated topic of discussion, Michael, dare we mention the cliff? All right, we've mentioned it. Whatever happened to the cliff? But
it was a tiny step, wasn't a cliff to fall off.
Yeah, was that a cliff? Oh, hey. Yeah, there's no mention of that. It's just like the debt bomb and all the other hysterical, ridiculous propositions that have been made regarding housing market outcomes. It gets very tiresome to continue to have to say this, but I guess we have to alert those that are involved or making decisions in the property market to really take a grain of salt with the stuff that you read, particularly from financial journalists and in the mass media. And once again, we're seeing settling now of the refinancing model. There has been no impact. In fact, housing markets have risen when they were supposed to have fallen because of people bailing out of their properties because they couldn't refinance. Absolutely no sign of that. And the balance, we're now seeing much more of a balance between refinancing and owner-occupied loans, where the proportion is now settling down.
There's been very, very few distressed or mortgagee sales. So again, it's another sign that those predictions haven't come about and people have, in an orderly manner, refinanced their loans and looked after their finances.
Which was always going to happen. And the other proposition is, firstly, Michael, they took out those 1 or 2% fixed rate loans. Of course, they saved a lot of money with that much lower rate. So that was a positive for their balance sheets. We've had very strong wages growth generally since then. As I said, we've also seen prices rising, values rising as well this year so far. So all those factors have helped absorb the increased costs that were there with refinancing at higher rates. And there's still plenty of confidence in the economy, as we see by those remarkable labour market data and the continued strong level of retail sales, So once again, I suggest that those that do pay heedance to those hysterical predictions, take note of those that make them, and just don't listen to them in terms of making your decisions, because you'll pay the price.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Andrew, every Sunday morning you report the latest auction market results on LinkedIn and we publish them on Property Update. But over the last weekend, the markets were distracted. There was the grand final, there was a Labor Day long weekend, there was school holidays, and that created, I guess, predictably lower auction results, Andrew.
Absolutely, Michael. We see this every year. I think that the weekend before, which of course was the Super Saturday that comes before those distractions, where we see a lot of front-end loading, was reasonably positive. As we discussed, there was actually clearance rates picked up despite that higher numbers of offerings. But we just had really a handful, particularly in Melbourne, of properties going under the hammer. So we can't take a lot of notice of these results. I think Sydney still had a clearance rate pushing up towards 70%. But as you said, Michael, it was a long weekend in Sydney, also Brisbane. It was a long weekend in Melbourne too, except it was the Friday, where it started. And of course, they had AFL Grand Final.
It was a religious holiday in Melbourne, Andrew.
Yes, I was fortunate, I'll use that word, to be down there over that weekend. But yeah, so distracted weekend. But look, we'll start to ramp up again next week, Michael. And of course, we'll have the market fully focused over the next couple of weeks, and just to see It's quite interesting because we did see the Super Saturday bounce back with some still results in favour of clearly in favour of sellers, particularly in Sydney and Adelaide. Whether that will continue going forward, but we await the next Super Saturday, which comes before the Melbourne Cup long weekend over the first week of November. So that's the week before the Melbourne Cup. We see again a big rise in numbers, and typically we do start to see higher listings generally as the season progresses. But we've had a very strong year this year, Michael. So a lot of the pent-up supply and demand has been satisfied, I would suggest. But nonetheless, it's still quite a heady housing market generally. And it's just affordability issues that are starting to obviously impact some market outcomes. And we shouldn't be surprised at that, given that a number of capital cities will record very close to double-figure growth this year.
Well, that's very different from the predictions this time last year when the Reserve Bank, and in fact, most of the bank economists suggested there could well be double-digit falls rather than rises.
I think they were certain about that, weren't they? It was, and I think, the double digits were going to move into the 20s, not just the 10s anyway.
Well, fortunately, that hasn't happened, and we'll be back each week to report on all the news. Thanks for your time, Andrew.
Yeah, a lot of interesting news coming up this week, Michael, and I look forward to discussing it with you again.